Hi guys, hope everybody's well. Can you see my chart? Let's get ready for another session, and this morning already some notable long-term levels have been breached, particularly in the currency markets, which I'll talk about in a minute. But you know, we've woken up this morning to what was a pretty bleak Asian session overnight. We're definitely back into nervous sort of flight to quality territory this morning. As you can see from my charts here, everything is pointing downwards. We're looking at the S&P at the top. We've got oil, we've got euro dollar. Everything is trending lower. It's a broad-based flight to quality across assets. It's an overall reduction of risk by investors as we continue to get an increasing nervousness about the sustainability of global economic recovery. Okay, we've spoken about this a lot over the last, well, couple of weeks now, as we've seen these sell-offs, and things are continuing. New lows again this morning across assets, and new highs in the bond market. So we've already had the UK gilt, we've already had the German Bund, being the respective 10-year government bonds, making all-time highs this morning, price-wise that is. Their yields making all-time lows. Let's talk about the notable. Well, here's the Bund. Okay, this is a quarterly chart, so we're going back to 93 here, and you can see what's happened during the credit crunch. Really from the Q3 of 2008, when Lehman's went bankrupt and really everything kicked off. It's been one-way traffic, and you can see actually this year, so that's the last 3 candles on this chart, bonds have only moved in one direction, and that is particularly the case for the Bund. Of course, we had the European debt crisis, which saw the Bund being the safe haven across Europe. It benefited immensely from that. But since the debt crisis has actually calmed down a lot, we've still seen the Bund make gains, and we're still seeing it make new all-time highs. So the new all-time high is now above 133, 133.02. All-time high, actually that was yesterday's high, sorry, 133.02. We're through and above that today. Okay, so bonds making new all-time highs. Let's talk about the currency markets, because what we've got this morning, and probably one of the biggest stories so far today, is the fact that the dollar yen has made a new 15-year low this morning. Again, this is a quarterly chart of the dollar versus the yen. What we've done is we've gone through the low that we saw at the end of last year, Q4 of 2009, which is around about, well, just below 85. We've gone through that, and this morning's low and the new 15-year low is at 84.15. Okay, this is the major target now for the dollar yen. This was the low set in the second quarter of 1995. Okay, so we're the lowest we've traded since 95 here, guys, for the dollar yen. That level, 79.70, I mean, I cannot even begin to describe how important that level is. Okay, should this trend continue in the coming weeks stroke months, 79.70 in the dollar yen is an enormous level. My chart doesn't go far enough back, it only goes back to 1978, but you can see it's comfortably the lowest this market has been in all of that time. So we're probably, well, even maybe looking at an all-time low there. 79.70, long-term support level for the dollar yen. Something to look out for in the coming months should this flight to quality continue. We've also had the euro making a 9-year low against the yen this morning. Okay, so everything is flight to quality. We've got the dollar strengthening against the euro. But let's just talk about equities here. I'm going to increase the size of my S&P chart. So we're in a downward trend channel. Again, new lows this morning. Yesterday's session was again a session of 2 halves, and we've seen this quite recently. First of all, we had some decent upside, and we managed to retrace all the way back up to 1080.25, yesterday's high. We got through 1078, which was that key resistance level. That was the highest the market had retraced since the big sell-off last week. Okay, 1078, we moved up and through that yesterday. New high yesterday, 1080.25. That was really, and the uptrend throughout the European morning was really just purely based on mergers and acquisitions activity, and it's being billed as Mergers Monday, as we get a lot of press over the weekend highlighting new mergers stories. So that continued yesterday. As I spoke about this yesterday, this often does boost sentiment in the market if there are mergers and acquisitions going on. However, I talked about this at length yesterday. The mergers and acquisitions activity in today's market, i.e. in the market we're seeing at the moment, isn't necessarily as positive as it ordinarily would be, because of the unique position we find ourselves in the business cycle here. But anyway, that mergers and acquisitions story just boosting markets yesterday in an absence of other news. Basically, we didn't have any economic data, so markets are happy to retrace some of the losses we've seen because of those merger stories. However, from the cash open, from 3 o'clock really, because the cash open boosted us up onto that high, but from 3 o'clock onwards, the second half of the session began, and it was very much along the same lines as the sessions we've seen over the last couple of weeks. People began to get nervous about the housing data today in particular. So we've got the US existing home sales today. Again, I've spoken at length about this. The housing market is integral to the recovery in the US economy, and I actually posted a market and spoke about an article on Bloomberg yesterday. Guys, some of you may have been logged out by then, but it is a fact that 7 of the last 8 recessions in the US, the recovery has been led by a recovery in the housing market. This is the first recession where we haven't seen the housing market leading the US economy out of recession. Okay, so the ultimate question, and the million-dollar question if you like, is can the US economy recover without its housing market? And it's something that we haven't really seen before in modern times, and therefore is it something that can actually happen? Of course, the housing situation in the US is still looking very bleak. Let me bring up the existing home sales chart over the last couple of years, or over the last 3 years. Let me just get this to size so you can see it all. So this is the chart for existing home sales over the last 3 years, and what we saw was a spike. First of all, so if you look at the left-hand y-axis, that is the number of homes being sold on an annualized basis, month on month. Okay, what we saw is two peaks on this chart. Obviously, everything's trending lower slightly through the subprime housing crisis and so on. Fewer homes getting sold, a decrease in activity in the housing market in the US. Then we had 2 spikes, one towards the end of 2009 and one in April and May of 2010. Okay, this is a direct result of government stimulus. This is the government exercising its power and actually implementing what's called the tax credit, which basically gave first-time buyers tax breaks of up to $8,000 if they bought a house, encouraging people into the housing market. Now, the first tax credit they introduced was due to expire at the end of November last year. This is why there was a big rush into the housing market prior to the expiry of that tax credit. When we got to the end of November, they said, actually guys, we're going to extend it till the end of April. So we had an initial dip off over winter and then another rise back up into the end of April, as we saw people clambering over themselves to get into the housing market to benefit from this tax credit. That tax credit has now expired, and we've seen housing sales decline since then. Not as aggressively as we've seen in the new home sales, mind you, but still, we've seen a decline, and we're expecting this decline to continue. I actually gave you some wrong information earlier, guys. The forecast for today's data for existing home sales, which is released at 3 o'clock, the forecast is for 4.65 million. The range is 3.96 million up to 5.2 million. The previous reading was 5.37 million. So we're expecting that decline to continue and actually to increase in its pace. Okay, so we're expecting further evidence of a pretty sharp decline in housing market activity for the month of July. We're expecting that decline to continue following the expiry of the tax credit at the end of April. Okay, so we're expecting this pattern to continue, and this will only add fuel to the fire of this flight to quality. Okay, we've particularly had bad data on the housing front over the last few months, and if this continues, the longer it continues, the harder it's going to be for the US economy to really get back on its feet and start to recover, along the lines as it was doing at the first half of 2010. So, big economic data release today, guys. It's at 3 o'clock. It's the only real data release of the day, and it's very, very important. Okay, we've already taken out yesterday's low this morning. Yesterday's low, Friday's low was at 1061.75. We're already below that. We did actually break it overnight. We didn't quite, in the sell-off in the second half of yesterday's session, we didn't quite get back down there, but we did overnight, initially finding support on that level, Friday's low, before